What's going on, guys? Welcome to part 2 of the Fibonacci segment of basic training. Part 1, we went over how to configure your Fibonacci tool and also how to plot it. Now I'm going to explain to you what you can use it for and how you can use it for that thing. Okay. So let's just jump straight into it. Now, as we remember from last video, part 1, how to plot it. If you want to plot it for an up move, you're going to go from the bottom, and then you're going to plot it at the high. Okay, you're going to start at the low, you're going to plot end at the high. Now, we're going to actually start focusing on the levels, right? And first, I should probably tell you what you can use it for, okay? You can use it for 3 things. You can use it for entries, you can use it for exits, and you can use it for stop losses. Okay, let's start off with entries. How can you use the Fibonacci extension tool for entries? Now, for entries, the main things we're going to focus on, the main levels we're going to focus on, are going to be the 0.5 and the 0.618 level, right? Now, the 0.5 level is actually called, another phrase for it is either equilibrium or 50% of the move, right? Equilibrium just means middle. Okay. Why is this important? Why is equilibrium important? Well, let's give you an example. Let's say you're Bob. Let's say on the day, on this day, you wanna buy. Okay. You're looking for longs. Let's go on to the lower time frame actually. Maybe like the 15-minute. Let's say you're looking for longs, okay? And price, I don't know, just imagine. Let's say price opens over here. Cool. We start coming down. And you are set on the day. Your bias is extremely bullish. You know, you're only looking for longs and longs only, and your mind is set on it, right? Well, we already had this move happen. Okay. What we can do is look at equilibrium. So, of this move, any price point above 50% of the move, so anywhere from here to here, is considered to be a premium price for the contract, right? Anything below that 50% is considered a discounted price for that contract. Okay, so naturally, if we're going to use it as an entry, we want to buy at a discounted rate. Okay, or people are going to want to buy at a discounted rate. Now, what does that mean for us? That means if the bias is bullish for the day, there are going to be a lot of orders below this 50% mark. Okay, people are going to want to buy here. So naturally, when buyers, like I explained in the fair value gap video, when buyers start getting exhausted here because we're like, okay, yo, we're coming up really high up. Okay, I'm not comfortable with buying in over here because there's a good chance price is going to come back down, right? And I have a terrible entry. Buyers are going to stop buying and sellers are going to start stepping in, and price is going to come down and down and down and down, and it's going to keep going down. And what this is considered is a retracement. Okay, it's going to retrace into the discount area of this move up. Now that means there's going to be a bunch of buy orders over here. People are going to want to buy here. So as soon as we get past this 50% level, people are like, okay, cool. This is a good place to buy. And people are going to be more open to buying it. Okay. If people start buying it, if people start buying a contract or an index or whatever it may be, naturally price is going to start coming up, because especially if there, or not especially, if there's more buyers than sellers, the perceived value of said thing is going to be higher, right? Supply and demand, you know. Now, how can we use this as an entry, right? Well, we're going to look at not only equilibrium, but also the 0.618. And the 0.618, you can kind of use it together with equilibrium. This is what's called the golden pocket, right? This is a very good point to buy in at. Why? Because price is still relatively high, meaning we're still relatively bullish. And on top of that, we are still in a discounted area in terms of this move right here. Okay, price is at a discounted, is on a discount. The contract is on a discount, essentially. Think of it that way. Okay. Now, one thing you could keep in mind, right, and this isn't always the case, but you want price to not close outside of this golden pocket. Now, if price, for example, if this candle closed down here, does that completely invalidate the fact that it is a retracement? No. It still could be a retracement. We could still reject off of this level, but the likelihood becomes a little slimmer, if that makes sense. So you should proceed with a little more caution. It's fine if we wick, we can wick all we want. But again, remember, it's important to note that that's why we want to figure out what time frame the move is on, right? Because the levels, or especially if we're looking, if we're considering the levels valid for something in terms of them closing above or below it, is only going to be true and is only going to hold if price closes above or below those levels on its corresponding time frame. Okay, so since this is considered technically a 4-hour move, this is a 4-hour equilibrium. So if price closes below this golden pocket, but on the 15-minute time frame, who cares? It's invalid. It's not considered bad, right? Now, if it closed below this pocket on the 4-hour time frame, then you should be a little more concerned. Okay, if this candle, this 4-hour candle closed right here, then you should be a little more cautious. Okay, so this we can use as a retracement for an entry, right? Again, keep in mind the time frame. This is a 4-hour retracement. What does that mean? That does not mean that just because we retraced here and we had a 5-minute, push up, okay? That doesn't mean, okay, yo, cool, let's enter. We're probably not gonna go below. This is definitely gonna hold, right? It could hold, right, if we see a rejection on the 5-minute, but it very possibly could be the opposite, where it could not hold, okay? So we want to use this, especially high time frame retracements into equilibrium, For in terms of an entry, and we'll go over that in future videos, we want to stack confluences, okay? What do I mean by that? Well, we're going to look for confluences, whether it's on the 15-minute time frame, right, for an entry, okay, or the 30-minute time frame for an entry, or whatever that may be. But again, this is a high time frame retrace, so price is likely gonna mess around a little bit. And just because we get a rejection or just because we get a move up on the lower time frame, that does not mean that the move is started. This could very well be a lower time frame retrace, right? Who knows? Okay. Now, what we can do if we want to look for an entry with equilibrium on the lower time frame is use a lower time frame move to find your entry, right? Example. Here. This is a very good one, actually. This move right here, from this high to, or this low to this high. Let's see what kind of move it is. This is a 5-minute move, right? So what can we do? We can put a fib extension here to here. Okay, cool. Let's get rid of this. Let's get rid of this. Let's actually get rid of this to clean it up a little bit. So this is a 5-minute move up, okay? Now, if we want to look for an entry, we would want to look for a retrace, okay, into equilibrium of this move up, right? Because over here we broke structure on the 5-minute to the upside. So now we're officially in 5-minute structure. To add in terms of confirmation or probability to our setups, we'd want a retracement on the 5-minute time frame. And what do we have? We not only have a fair value gap right here, we can use as a retracement, but we also have equilibrium right here. And we have the 0.68 extension. Okay. And equilibrium works very well when it's paired with other confluences, specifically fair value gaps. Okay. From here, what you can do, finally, is we can go on the 1-minute time frame. We can look for confirmation on the 1-minute time frame. Okay. Boom, we retrace. Okay, break structure, blah, blah, blah. Yeah, break structure. We inverse this gap. We enter longs, boom, whatever, cool. That's how you can enter or use the Fibonacci extension as a entry, right? Now, in terms of the entry, you're mainly using it as a retrace, right? It's, sorry, I phrased it wrong. It's mainly a retrace tool. A tool to see retracements on, okay? Now, this actually brings up the next point on how we can use the Fibonacci tool, and that's to set stop losses, okay? Here's where it gets interesting, right? Cool, you answered here. You could put your stops right here, okay? But where do we want to put our stops? I personally like to put my stops below, let's say I'm in a long position, below the lowest possible point that price may retrace to, okay? What does that mean? Let's say this is where I answered, right? My stops, we come over here, we look to the left, and we scan. Is there anything that price may want to retrace to? before continuing our move up, right? Because that's the last thing we want to have happen when we're entering a trade, is for us to just get manipulated and then the move goes in our direction, right? So we get stopped out, we lose, but then boom, voila. We get full TP, but we're not in the position. We lost, okay? Here's where the Fibonacci tool comes in handy. I wouldn't say this should be the only thing you're looking at. You should be looking at all the other confluences, right? But this is one of them, okay? Let's say you want to put your stops below this low, and you're thinking, okay, you know what? You may think if price comes below this low, then my trade is probably, there's a good chance my trade is invalid, right? We're coming onto the lower and lower time frames. Well, remember, we had this 5-minute, or this fib extension is on the 5-minute time frame, okay? And we never actually ended up filling this 0.6, excuse me, 0.618 level, okay? You know, even though we broke structure on the 1-minute time frame, you know, we changed order flow from bearish to bullish, there's still a very good possibility that price may want to come down a little lower and hit this 0.618 level, okay? It wouldn't be without reason. You know, it's completely reasonable for price to come in down and do this, right? So now, keeping that in mind, what we would want to do is we would want to put our stops below the 0.618 level, okay? But here's the kicker. Let's say this level also got hit. Pretend like this wick also ended up getting hit, okay? Now you're like, ah, shoot. Well, this level was officially filled, okay? We officially retraced down to the 0.618 level. What are the odds that price is going to want to come down even further? Very, very, very low, okay? Now, let's say another example. Let's say we don't have any of this, okay? Let's say you enter right over here. Let's say these stops are, I'd actually have to find a different example for this. Let me think real quick. Okay, here, I found a better example, right? Let's say this example works much better with what I'm about to say. So let's say you didn't enter with a perfect setup, right? Let's say you used one of my strategies, okay, one of my tricks that I like to use, and you entered in a very low leverage position. As soon as, what do? We came in, we filled this high time frame equilibrium. No entry here. We kept going down. We kept going down. We filled this high time frame 0.618 level. Okay, nothing. We keep going down. We keep going down. We keep going down. We keep going down. We're still in a discount. On the 4-hour, price still hasn't closed below this level. Cool. Now we start getting a wick up. Okay. And lo and behold, what happens? We actually, here, let me just make sure. Okay. Lo and behold, we get a low time frame confirmation saying that, hey, price may start reversing. Okay. With this inverse fair value gap right here. Or if you want something a little more, I guess you could say secure, as you can wait for this 1-minute fair value gap to inverse, right? Let's use the second one as an example. Okay. Let's say you entered right over here for a long position. Again, low leverage, very strong bias. We're in a discount. Cool. We're letting this bad boy run. We're trying to get in as early of an entry as possible, as good of an entry as possible. Okay. Now, here's where the issue is. Okay. We want our stops to be tight as possible, but we also want to have them below the lowest possible point of that price may retrace to. So what I like to do in this case is I like to constantly monitor the Fib tool. Okay. What do I mean by this? Let's say we entered right here. First thing I'm going to do is I'm going to look to my left. Oh, cool. We have a 1 minute fair value gap right here. There's a decent possibility that price may retrace down to this fair value gap. Cool. What else? Nothing. But not quite. Now, like I said, even though this is on the 1 minute time frame, I don't like to use it. This is a very rare case scenario. And this is very advanced, but I'm still going to show you this because it works for all time frames, right? So where do we enter here? Okay. Where's the lowest point of the move, which we think is going to be the lowest point of the move? If this trade plays out, it would be down here. Okay. Where did we enter? We entered right here. So currently, pretend like this is all you see in terms of price action. This is the highest point, okay? But this isn't necessarily a high. Why are we still mapping out the fib level? Well, that is because if this ends up being a high, boom. If this turns out to be a high and price starts reversing, this would be a valid high, okay? And we can see if that happens. Here are our levels. Here's equilibrium. So there's a decent chance price may want to retrace down to here, which is below this gap. So us putting our stops right over here is dangerous because price very well could come in and come all the way down, fill in this gap without closing, but still just a wick, hit equilibrium, hit 0.18, and then reverse and come up. And again, this works on the higher time frame as well. Just pretend like this is a 5 minute, pretend like we're on the 5 minute time frame. Okay, because this is something price would do on the 5 minute time frame. This is how price would behave on the 5 minute time frame. Okay. Since we want our stops to be as tight as humanly possible because of the nature of our entry, we want to see if we can have them further up than this low. So from there, we ask ourselves, what is the lowest possible point of retracement? Well, this is going to fall somewhere between the 0.786 level and the actual true low. Why? Because the 0.86 level is a level that indicates a change in order flow only if price closes below it. Okay. In its corresponding time frame. So if you are measuring the move up on the 5 minute, price would need to close below this level technically for it to be considered a break of structure. But it would also but it would need to close on the 5 minute time frame, right? I don't use this as a change of order flow in my strategy. I just like to use this as a level where that indicates, hey, if we get here, we are very, very, very extended, right? There's a very good possibility that we could continue lower if we get at this level or below it. Even if we don't close below it, there's still a very decent possibility that we may continue down. Why? Well, because there's a lot of selling pressure. Okay. I'm not saying don't use this level as a means to indicate a break of structure, because it very well could be one. And actually, funny enough, we can see it here. High. Okay, so technically this is a high. So we're going to treat it as a high. Boom, boom. Okay, so pretend this gap wasn't here. Pretend this price action was very efficient, very balanced. Well, instead of waiting for price to come all the way up here and close all the way above this wick for it to be considered a break of structure, if it closes above this 0.86 level, like it did right here, this is also considered a break of structure. Okay, obviously, just because we closed above this fair value gap, that also means it's a change in order flow, a break of structure. Okay, change in order flow. They're pretty interchangeable. But just as an example, if we didn't have that, if we didn't have those gaps, and this was just very wicky and very balanced out price action. So that's how you can use them as stops. How can you use equilibrium as take profits? That's the next thing. Well, this is actually also something I like to do in my trading. Okay. And sometimes I like to trade this way. Okay, same thing here. We map out our move. We find its levels. Cool. We go down to the lower time frame. Actually, here, let's do this too. Boom. Boom. High. Again, we're not going to talk about entries here just because I don't want to get it too confusing. I don't want to give you too much information at once, right? But I'm going to very briefly go over this. Let's say, okay, yeah, boom. We swept liquidity. We took out a very significant high. Whatever. We're looking for shorts. Boom, we find a setup. We see a 5-minute inversion right over here. Boom, 5-minute inversion. And we enter a short position. Boom, stops above this high. And here is where it gets interesting. Now, looking at the higher time frame, we are very bullish. Okay. And not only are we very bullish, but we are very, 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 very far away from the nearest low. Okay, if we enter shorts. So when you're entering this position, right, if we are bullish on the higher time frame, we are very far from any kind of liquidity like we are right here. It's not to say that price isn't going to make a move down, right? It is going to move down, but it's not going to be a conventional move down. Okay, it's going to be a retrace to move down. You have to understand that. More likely than not, we're very bullish, but we get, confirmations for sells, and we maintain bullish order flow. And on top of that, the nearest low is very far away from our entry or from the level that we're reacting off of, the high time frame level. Then the odds are that price is just going to want to retrace into something. And continue on with the move. Okay. The up move, move up. So since we don't, since we don't have any liquidity, we know for sure price isn't going to come all the way down here, right? Unless in an event of a news, the odds of price coming all the way down to take out this low to continue a move up is very, very, very unlikely, okay? Considering how bullish we are. So then you may ask yourself, okay, then where could I find an exit? Well, obviously, you can use fair value gaps as an exit, right? Boom, boom. Funny enough, like I talked about, equilibrium of this fair value gap, it's still kind of considered Fibonacci extension level concept. Or you can use the Fibonacci levels themselves, okay? Either if this gap didn't exist, right? Or, let's say this gap wasn't here. Let's say we did not have an hourly gap here. Let's say this what came all the way down here and then all the way back up. And this was just very balanced out price action. And for whatever reason, even on the 30-minute, there isn't, anything. Well, then you want to be safe and you want to have your take profit at equilibrium, because the odds of us, setting up to move further down, giving us a high time frame sweep of a level and then a slightly lower time frame confirmation, more likely than not, especially in the 5-minute, more likely than not, it is going to make some kind of a move down and it's going to make a higher time frame retracement. Okay. Now, more likely than not, what happens is there is a fair value gap that you can base this off of, and you can actually use these in combination, right? How do you go about using these in combination? Okay. Well, let's give an example here. Let's say on the 4-hour time frame, equilibrium stays here. Okay. Let's say there wasn't a hourly gap. Okay. Let's say all you saw was 30-minute gaps, and I'm actually going to plot them out. Okay. Well, you still want to mark out equilibrium of that move up. Why? Because now look at this, okay? This 30-minute fair value gap is still in the premium of this move up. So the odds of this fair value gap getting respected are fairly low, okay? Now the next fair value gap right over here is considered in the discount, okay, of this move up. So if price comes down into this gap, price is considered to be at a discounted rate. The contract is considered to be at a discounted price. Okay. Here's where things get kind of a little complicated and kind of where you want to be intuitive about this. This is pretty far down. This is pretty far away from equilibrium and kind of below the 0.618 extension level, right? Now, is that to say that it won't get wicked out? No. There's a very big possibility that it could, right? But you just have to be cautious about it. So what I would personally do, something that you could do in this case, in this scenario, is you can have multiple take profits, okay? You can have one, you just completely disregard this gap, right? This gap is going to get blown straight through, especially if we get to it. You can have your first take profit at 0.5 equilibrium, okay? Take out majority of your position here. Now you can do a few things here, okay? You can have your final take profit either at 0.618 or at the beginning of this gap, or at equilibrium of this gap. Why? Because we're still above the 0.786 level, right? So we know that price can still come all the way down to equilibrium of this gap without it actually, being considered high risk and still a retracement, a still possible pleasable point of retracement, right? Where price could retrace to. And that's actually what happened. I did not trade this day, I don't believe. I don't even know. No, this was yesterday. I did trade this day. Yeah. Surprised I didn't use equilibrium. I don't even remember this trade. Because this is at 12, because I took longs. That's why. Okay, cool. Little off topic, right? But since this fair value gap right here, 30-minute fair value gap is, or at least equilibrium of this 30-minute fair value gap, is above this level that is considered kind of like the danger zone, the odds, there's still pretty decent odds that it's going to come and retrace down into it and want to fill this, whatever orders there may be in here. I personally wouldn't put stops or take profits at equilibrium. I would put it at the top of this gap, right? Just to, minimize my risk. But let's say there was another gap, 30-minute gap. Just pretend. Okay, shh. Pretend here. This is just for examples, right? Pretend like there was another 30-minute fair value gap right here. Okay. Okay. What are the odds of this fair value gap getting retraced into? Keeping in mind how bullish we are. Very low. Why? Look how far down it is. Look where price would have to go for us to come down into this gap. We would have to go past this 0.786 level. Okay. More likely than not, if we are so bullish, we're not going to go past this level. Okay. So this gap would be, you wouldn't even consider this, you wouldn't even think about this as a exit, right? As a take profit level. Unless for some reason you have conviction that you're going to come and take out these lows, which in that case, why wouldn't you just target these lows, right? Let's say we just floated around here a little bit, we broke structure on the high time frames, we're actually bearish now. Then these lows would be a better point of interest or a higher point of interest in terms of a take profit level. Okay, cool. That's that. Those are your extensions, or not your extensions. Those are your retracements in terms of Fibonacci. I know it's really confusing. I'm trying to explain it as best as I can. But, this video is getting long. There's just a lot of material to cover. Okay. So we covered entries. We covered exits. We covered stop losses, or how you can place stops. We covered entries. And we covered take profits. Now, retracements, Fibonacci retracements, are one way to determine a take profit. But there's more than one thing in terms of the Fibonacci tool that you can use to determine a take profit other than the Fibonacci retracements, and those are the Fibonacci extensions. Okay. What are Fibonacci extensions? So lo and behold, I'm going to actually use a trade I actually took. How long ago? 3 hours and 45 minutes up until this point in me recording this video, right? I'm going to use this as an example. Okay, this is on gold. Okay, so we come up onto the higher time frame. This is actually, I'm looking, I'm searching, right? We are at all-time highs, and this mainly really works at all-time highs. I wouldn't use this any other time other than all-time highs, right? Because if we have liquidity, I'd much rather target liquidity than extensions, okay? But this is how we use the extensions as the take profit levels. These are the extensions, 0.272, or no, 1.272, 1.618, and 2.618, okay? You find the nearest, leg down if you're at all-time highs, and you go from the top to the very lowest point of the move. Okay, let's redo this. Okay, boom. Very highest point of the move to the very lowest point of the move. And this is beyond a 4-hour move. This is not a daily move somehow. So this is a 4-hour move, but a really weird one. Doesn't matter. What matters is that we have this move mapped out. Okay. Now, when you're looking for take profits, sure, can we use these highs right here? 1, 2, 3, 4. Can we use those highs in terms of a take profit? Of course we can. Okay. But what happens if we keep pushing above those highs? Right? Without retracement and a new high to target. Right? In that case scenario, I personally like to use fib extensions, right? These three in particular. At all-time highs, me personally, I like to use just the first one. And that's it. And I make sure I use it as a high time frame one. And I probably used it the wrong way there. And I'll show you what I mean by that, because let me check something really quick. Nope. No, I used it the right way. Cool, whatever. Let's go down to the lower time frame. As we can see, we already took out 0.278 hours, 1.272. I don't know what the fuck I just said over there, but and it's not. We're still very bullish, right? 15-minute time frame, bullish, yeah. 30-minute time frame, bullish. Hourly, bullish. Okay. We have no reason to go down. We have not even changed our order flow on the higher time frames. So we can look for entries, but we can use these extensions in terms of take profit areas. Okay, and that's actually what I did over here. Here we're bullish on the 15-minute, right? We filled in this 15-minute gap. There's no reason for us to come back into it. Okay, so from there, we scale further down onto the 5-minute time frame. We have a 5-minute gap. Cool. there, we come into the 5-minute gap, blah, 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 blah. We look for an entry. Okay. Honestly, I just entered wherever because I saw it was choppy, and I just made sure my stops were below the most probable point of retracement for this. Okay. Obviously, I did not put my stops at the most probable point of retracement because that would have been down here, I guess. Or maybe I just, who knows, maybe I just targeted a level that is too high time frame for this low time frame setup. Okay, maybe I should have waited for a 30-minute, yeah, like this. Well, sometimes, you just get cooked, but that's besides the point. That's not what I'm trying to show you. What I'm trying to show you here is that I actually missed out on one thing, okay? And it's this. So as we were coming up and retracing into this, making this 5-minute retrace, as well as this 15-minute retrace, when we started coming up the lowest point over here, take a look at this. So you would say of this move, right? It's safe to assume that this is the high, this is the low. Now, what kind of move is this? This is a 30-minute move? Whatever, I just looked at it on the 5-minute time frame. It's a little easier to spot, right? So here's the high, here's the low. Okay. Unless we came down and we retraced even further, let's say we came down over here, this is considered the low. But if we retraced further, then we would just update it, right? We just do one of these, okay? But look what happened here. Wait, this doesn't look right. Because it's not, because there you go. Look what happened here. For this 5-minute retrace, or 15-minute retrace, or 30-minute retrace, whatever it was, we actually hit the 1.272 extension, not retracement, of this move. And I failed to see that. And that's another thing I like to point out, is that it doesn't necessarily have to be high time frame moves. Okay. Obviously, it reacts off of the high time frame extensions too, right? You got your high time frame extension from here. The extension, this 1.272, is the extension of this 4-hour move down. And on the 4-hour time frame, it may not seem like it did anything. Like it looks like price was not phased at all by that level. But if you take a closer look, we had some hesitation. We had some pullbacks, sure, on the lower time frame, but we still had some retracements. We had to fill some orders because people were closing out their positions here. And that's the only reason these levels work, is because people use them and because people think they use them. So they put their orders in at these levels. So if I was a little more intuitive, what I could have done is I could have been an intellectual, and I could have, instead of putting my take profits here, which is a 4-hour extension, not even liquidity, a 4-hour extension without much, not only without a 30-minute retracement. I mean, I guess there was a 30-minute retracement, but we kind of already took out some highs on that 30-minute retrace. No, we didn't. See, we're learning as we go here. This technically just would have been a safer bet, I guess you could call it, right? Because I could have put stops here. My stops could have been tighter, right? Because we are targeting a 5-minute extension. And so, which means if we get 5-minute confirmation, which actually happened right here, in terms of a change in order flow, then that would mean that the lowest pleasable point that we could retrace to would be another 5-minute confluence, which could be either a fair value gap if it formed, which it did not here, or if we take, oops, yeah, no, that was correct. If we take whatever the highest point of that area is, so like let's say price close here, this is the wick, right? And we're currently chilling here. I'm sorry, I'm gonna get rid of this. Let's say we were chilling here because this 5-minute candle closed. Well, then this would have been the highest point, and then this would have been the lowest point, and the lowest possible point of retracement could have been right here, which would have given us tighter stops, but not only that, also a much safer take profit level, right? Because even if we did have to retrace, it would have been a small retrace. So we actually ended up taking it, which, you know, you learn something new every day. But that's all I have for you guys in terms of the Fibonacci. I might still split even this one, but, you know, some decent content. I hope I explained it well enough for you guys to be able to get a comprehensive understanding of how to use this tool. But anyways, thank you for watching.